Welcome to the Commercial Property Podcast. My name is Susie Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.susiecarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today I'm talking about the market. I want to give you a bit of a market update, but also talk to you about what the real fundamentals are in a market like we're in at the moment, and who should and shouldn't be kind of playing in that particular market. So listen in, because I'm going to go into quite a lot of detail in this one. So the first thing to say is that you would have had to be hiding under a rock to not understand what's happening in the market right now or in the world right now. So we've got, and obviously this is a podcast that's being recorded in April 2026. So we have a war raging in the Middle East, Iran and USA, Israel, various other countries getting involved now. I won't go into any detail of that. And even if you're listening to this 2, 3, 4 years on, all the fundamentals that I'm talking about in times of uncertainty will apply. So don't press stop now, because actually everything I'm talking about now, whilst it's relevant to March and April 2026, is going to be relevant whenever there's these times of uncertainty. So there's a lot of noise, basically, of various types. And there's a lot of press articles, there's lots of agent correspondence are saying that deals are on hold, there's uncertainty in the market, there's a lot of wait and see going on, lenders are starting to feel very jittery, and it's just the classic stuff. And this is what happens when there's uncertainty, because markets are run by sentiment. And, so we might think that everyone who's dealing in financial markets and in real estate are all very logical and, very business-like. And of course, to some degree, everybody is. But also markets are ruled by emotion, how people are feeling. And if people are feeling jittery, then they will put the brakes on deals. They will want to get a better deal. You'll start running sensitivities. You'll be thinking about where your money's going. You'll be wanting to make sure that you're not rushing into something and making a mistake. So it's really important that there's an understanding of this. So this is just classic human behavior. This is why we have, bear markets, bull markets. There's usually a trigger, but it's how markets react. This is just how it works. So there's nothing unusual going on right now. You'll read reports about, transactions are on hold and, could this be a dip for the commercial property market? Well, yes, all of the above. Like the market could go down quite substantially. But obviously in times of great problems, there's great opportunities. And I was very, very active in the commercial property market, but in the corporate world in 2008. And I saw firsthand, I was living firsthand what was happening. And I joined the market in the previous kind of downturn. So this is my third downturn. I feel relatively familiar with it now. And, in 2008, the world was literally falling apart. I don't need to repeat what happened then. Lehman's went under, and then it was basically a domino effect. Places like Land Securities, where I was working at that time, values were halved overnight of commercial real estate, prime commercial real estate. But what was super interesting, and what I observed at the time, was that the people who did really well were those that had understood their leverage going into those kind of markets. They'd understood their strategy. they bought the right assets, and importantly, the people who really profited from that time were those that were in cash, that that knew exactly what they wanted to buy, and they were ready to buy it effectively. And we were selling things probably 50% of what they were worth, maybe even 2 months before, because the company had to recapitalize. None of this is commercially sensitive because this is all in the accounts. But literally 2-3 years later, the people who bought those kind of assets were selling them for a huge profit. And that is why the window of opportunity has potentially just widened even further. So rather than being scared of times like this, it's about keeping a calm head when everyone else around you is losing theirs, and actually looking at where the opportunities are. But if you get this stuff wrong right now, you won't just miss the opportunity, you're going to walk into a bad deal, which could basically you'll be unpicking for the next 5 years. So we don't want to get into that point. We want to basically we want to be at a point where we understand what a good deal looks like, what the right market is, and make sure that we're buying the right stuff. So it's very difficult to call bottom of markets. The market could go down substantially. It could kind of just flatten out. It could go down a bit. It could even go up a little bit. Who knows? But at the end of the day, none of us have got crystal balls. What we can do, though, is we can invest in the right kind of properties at the right price and have the right plan for it. And also structure our deals in the right way with the right kind of finance. So, we're taking back control, basically, because markets like this are all about lack of control. What we want to do is we want to take back control. And, it's not a broken market, it's a selective market. And this is why it's really important to understand this stuff. When there's less competition, when people are feeling jittery, there's better negotiation power for deals. When you've got an ability to structure deals the way you want to, you can basically get better incentives, a better price, better terms, maybe even put forward creative deals like exchange delay completion, etc. We can definitely buy below peak sentiment pricing, and we can actually force value through. I wouldn't recommend really you buy anything at the moment. Everyone's got different criteria for deals, but don't buy anything at the moment where you can't force value through. You want to be able to asset manage your properties so you can add value, so that when the market recovers, you can come out of it really, really well. Your money isn't made when markets feel safe. Money is made when you can see clearly what others can't. So I'm going to try and help you with that. And, I'm going to be doing a number of briefings to my clients over the next few weeks about all this stuff to make sure that everyone understands it perfectly. So first of all, who should be buying right now? So when I start off with my board clients, my 6-month program that I work with clients very intensely, we start with the end in mind. We work out where they want to get to, and then we work back from there. But we also talk about niching. And, I strongly believe there's so much going on in the commercial property market. There's so many different types of businesses, so many different types of property. You can't be, jack of all trades. You have to be the master of 1, 2, 3 niches max. Ideally do it one by one to begin with, so you can kind of go an inch wide and a mile deep, because niching is really where you can get the competitive advantage. You get to understand a market really well. You build the relationships in that market, and you can move quicker than everybody else because you have an understanding of that market. So investors who, number one really is investors who own their niche, understand their niche, they know what they're looking for and why, will definitely have a competitive advantage here because they have already kind of built the relationships or understand exactly what they want to buy. Number two, investors who understand and focus on tenant demand, not just the asset. So commercial property is really all about basic economic supply and demand. What we want to do is we want to buy properties where the supply demand equation is in your favor. So there's less of supply of a type of property and they are in a lot of demand. And you can see that demand lasting for a number of years, certainly during your hold period, so that you're future-proofing it. And that's obviously how you get capital uplifts over the medium to long term. So investors who are thinking, will this let quickly at a good rent, at good lease terms, are kind of winning out over, oh, this looks like a nice place to invest, or this looks good, that won't cut it in this market. Obviously, you need to run proper numbers and sensitivities at the best of times, but definitely in this kind of market, making sure that you're stress testing deals and not just hoping for the best, really, really important. Investors who are comfortable negotiating, like genuinely, if you don't have an awkward feeling in the pit of your stomach when you're submitting an offer, you're probably putting it in too high. And that's a little bit churlish, but, I think it is true that especially in times like this, think about structuring deals. I quite often say my clients put 2 or 3 different offers forward, which are on slightly different bases and are pitched at slightly different levels. So ignore the asking price, work out where a deal works for you. You're buying based on your numbers, not the agent or the vendor's numbers. That's really important. And you know what? If you don't get that property, then just follow up, because they're obviously not motivated enough to sell it to you. And, you want to play the asset management game, which is, reletting, re-gearing leases, multi-let potential, adding income streams. So investors who are executing a strategy are the ones who should be buying at the moment. So you have your strategy, and obviously you can get that strategy together very quickly, but you need to know exactly what you're buying, why you're buying it. You need to have a plan for when you buy it. You need to have a plan for how you buy it. And then, you can take advantage of a market where vendors and agents are starting to become a lot more motivated. So who shouldn't be buying at the moment? Well, investors who haven't got a clear strategy for a niche. If you don't know what good looks like, you can't spot a good deal. That's just a fact. So you need to make sure you absolutely understand what's working, and just really as importantly, what works for you, because not all deals are for everybody. Everyone's got slightly different risk profiles. They've got different aims and objectives, different amounts of leverage located in different areas. So you want to make sure a deal might work perfectly well for somebody else, but just not for you. So be very clear with yourself. Start with the end in mind. Be very clear about what you want to go for.
This episode is brought to you by Bond Finance Limited, your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
Investors who chase yield without really understanding risk. So, higher risk deals will be very attractively priced at the moment, and they are very attractively priced at the moment. If you see a property, of 15%, 20%, even 30% in some occasions, then that can be that can woo you, that can be very tempting. But all that a yield does is reflect risk. So if you understand the risk, then that's fine. And if you understand how to get yield compression, reduce the yield by reducing the risk, then obviously that's a really valuable strategy and one you should definitely be considering. But high yield often means weak tenants, poor locations, short leases, sectors that are going down, whatever it might be, like bad locations, whatever it might be. So make sure you absolutely understand the risk of your asset before you buy it. There's no point finding this stuff out later. We want to understand it. And that's why niching obviously is really good, because you've gone through that process already. Also, number 3, investors who aren't doing enough due diligence. If you're not checking covenant strength of tenants, their accounts, reputation, etc., you're gambling. And, this brings me to another point in that tenant choice in these kind of markets is really, really important, because there's tenants who weather the storm, where their goods will always be in demand for one reason or another, or their goods might or their services and goods might actually increase in demand in times like this. And there's others where actually, maybe because consumer sentiment is bad, or whatever the reason is, that they're going to really struggle. So think about the tenant choice before you buy as well. Also, make sure you understand leases, really basic stuff, break clauses, short leases, repairing obligations. These matter more than ever. What would be ideal in this market is being the ability to put longer leases in place so you can weather the storm and kind of finance on that basis. And remember that if there's a break clause in a lease, even if it's a 20-year lease, the lease only is as long as the break clause, if it's a tenant's break clause, and values will only value up to the break clause. So just be very clear that, you're potentially, if there's a 20-year lease with an annual break clause, you're only actually buying an annual lease. You're only buying a 1-year lease. So be very clear about what you're buying. And then also, investors that haven't priced in voids and uncertainty into their deal, because the market requires resilience and a longer term view. And if you are an existing portfolio holder in commercial, you need to be really carefully reviewing your portfolio. Look for any risks, look for where you could maybe start to lock in tenants a bit more. Look at kind of, where the risk points lie in your portfolio, and try and do everything you can to alleviate those while you can. And that's really, really important. And to be honest, that's an ongoing process that you should be looking at with your portfolio anyway. So now is not the time to have a go. It's a time to be highly, highly strategic. And, I can't stress that enough. It's all about being strategic. So the non-negotiables in this market are niche first, always. Number 2, location must be absolutely tight and demand-led. Tenant quality is absolutely critical. Lease length and terms must be understood, as must all the risks associated with a property. And you must understand your numbers really carefully, run sensitivities, and make sure that you can add value to the property. That is really, really important. And if you get these things right, this market suddenly opens up into the world of opportunity. The window of opportunity is absolutely gaping wide open right now. And I anticipate that's only going to get better if you understand what you want to buy. So just to summarize then, if you're feeling uncertain right now, that's actually a good thing, because it means you're aware. It means you're aware of the risk. Now, that's not a reason to freeze and not do anything. Sometimes it's good to just pause sometimes, but equally pausing to get your strategic direction of travel sorted is really, really important, so that you're ready to take advantage of opportunities. The goal is to move from uncertainty to clarity, because when you're certain on your strategy, your niche, your numbers, this marketplace basically becomes a place that you can move with confidence and with a lot of comfort as well. And this market is one where you want to be. If you're confident on your numbers and confident on your financing and your price, then you want to be putting offers out on a load of stuff in your niche that maybe won't get accepted straight away, but that's where you follow up. You diarize those follow-ups. And that's what I'll be working on with my clients really carefully and closely over the next year or so, plus, to make sure that everybody absolutely capitalizes on these times and doesn't make any mistakes. So these markets aren't for everybody, but if you're very clear in your strategic direction of travel, it's absolutely a world of opportunity. So thanks for joining me today, and I look forward to catching up with you next time on the Commercial Property Podcast.